Hello, everyone, and welcome to another Southern California housing market update. Today, we are going to do our whole market update. This is for LA and Orange counties. My name is Stephen Meade with Domicile Real Estate. We are located here in Long Beach, right in the middle between LA and Orange counties. And we're going to talk a little bit about the difference between fact, fiction, LA, and Orange counties because there's a lot going on right now. If you've read in the newspapers or if you have read online, you'll see there's a number of stories talking about the market changing across the country. Now, we've largely been spared of that here in Southern California, but there are some exceptions. So, what I'd like to do is jump into our stats. We always want to start with the data first, and then we can kind of go over what I think is going on and really what you need to be aware of. Our first graph here is talking about our total active listings in the market. And if you look here, both in our under $1 million category and our $1.2 million categories, we do have more inventory than we have had last year. Now, these aren't huge changes, right? Like I think it might give you the appearance, or if you look at some of these online news sources, they will tell you that inventory is just exploding all over the place. The reality is that isn't actually true. And I would even argue we're still seeing that effect where we're not seeing a ton of valid inventory. And what do I mean by that? Well, what's valid inventory versus invalid inventory, right? Valid inventory is a person who is willing to sell their home at the market price if that buyer should appear. And I think what we've got is we've got a lot of sellers who are testing the market, who are kind of putting their home up as sort of like a make me move offering. I still don't know how accurate this total active listings figure really is when you drill down to it in that way. So if we look at our last 14 days of new listings, I think this tells you another interesting story, right? If we look under $1 million, these are pretty much similar numbers to where we were at last year in terms of new listings hitting the market. If we look in $1 to $2 million, that number is up a little bit, but it's not entirely dissimilar from the number we saw in the middle of June last year. So again, like we're still playing within the ranges that we would expect. Now, if we look at the demand side of things, I think that one's really interesting, right? Because both of these numbers, both under $1 million as well as $1 to $2 million, these are both right at about the same level they were at last year. So we're really seeing the same level of demand in the marketplace. We don't see a huge shift and a slide in demand. Now, there is a little bit of an exception to that, and I'm going to talk about two of those things real quick. First off, we're going to talk about the difference between LA and Orange counties. I'm thinking of doing a supplemental little video on this, but basically I will summarize, especially if you go into northern LA County, reading like San Fernando Valley and northward, we're seeing that that market is quite a bit slower and less active than, say, the Orange County market, right? And it's a gradient. As you go south in LA, the market starts to look more and more like the Orange County market. If we go to our absorption rate, right, these figures are a little bit lower than we were at last year, but they're not really entirely dissimilar than where we were at last year around this time. And in fact, if you look last year, you'll notice that $1 to $2 million demand was actually slipping a little bit, right? And this year it's only a slight downward slope. So kind of really a lot more of the same. We're not seeing that same level of market drop that we are seeing in some other markets around the country. If you look at our closed prices, and again, I always caution people, remember this data is based on homes that went into escrow 30 to 45 days ago on average. So if you look at this, our 75th percentile, that took a recent jump over the last month. Our median took a jump as well. And our 25th percentile took a jump. But what I think is interesting is if you compare these numbers to a year ago, we are in very much the same spot, maybe some very modest increases. That really indicates a market that is in equilibrium and in sort of a form of stability, dare I say, actually kind of a bit of a stagnation of the market versus a year ago. If we look at our still active after 14 days on the market, that number is rising a little bit. So that does give me just a little bit of caution, right? Because a rising figure here generally means slackening demand. It means that basically, these homes that are new on the market after 14 days, they are still staying on that market, a higher percentage of them. But again, we've kind of got a little bit of an issue with the quality of inventory. We're seeing buyers are being picky. They're saying, I'm going to wait for the house that I want. I'm not just going to go after the house that I can get today. If we look at our list to close ratio, right, this really is a definition of how close are buyers and sellers in that agreement on what their home is worth. And if you look at this, we are very close to 100%. That really indicates a market where buyers and sellers of the homes that are actually closing, right? Of the homes that are getting under contract and they are closing and coming to completion, that those markets, those buyers and sellers are in largely agreement about the price. They price the home where it ends up selling for very close to 100% of that list price. If we look at days on market for new contracts, this is the other thing I was going to talk about that does give me a little bit of pause. And we have been seeing, and we're going to talk about this in a second, interest rates have been inching up a bit due to macroeconomic and geopolitical considerations that really disproportionately affects the entry level end of the market more than the established market. Why? Because the entry level end of the market is likely to have a much smaller down payment. They also tend to be much more payment sensitive in general. And if you look at this, we see that days on market for new contracts rising pretty dramatically for that under 1 million, yet it is actually going down for that 1 to 2 million. And it's really at a pretty low point. It doesn't show signs of increasing. So, kind of a tale of two markets here. I'd love to see if that under 1 million figure sticks and what that really means. There's a couple of explanations. One of them is that these buyers really are taking a wait and see approach. The other is that they are starting to run out of viable inventory. So, they are now going back to homes and revisiting those properties that have been on the market longer. So, kind of two explanations there. We'll have to wait and see which one we think it is. Now, if we look at our affordability chart, I call this the three-way. And one of the things I really look at in this, and I've harped on it, is it's that difference between that payment index and rent index. And if you look at this, that rent index, which was pretty low towards the end of last year, has risen a bit. And that really gives you some room for that payment index to rise, right? It's that differential that really determines if someone is in the marketplace, are they buying or are they renting, right? Or are they moving out of state, right? And if you see both of these numbers go together, that is kind of a potential long-term outcome, right? Is that people are leaving because they can't afford the housing. However, if we're looking at this in more of a short-term perspective, when those numbers get closer together, that gives more room for prices to rise on the home front. So I don't see a lot of the same structural conditions that we're seeing in other markets that are particularly soft. Like this is not an Austin market. This is not a Nashville market. This is not an Orlando market, right? Southern California is very different than all of those places and has a lot of different governing forces. We are still in a perennial shortage of viable homes that people want to buy. Finally, we've got our prevailing mortgage rates, right? You see this beautiful drop down to about 6%, and then a bit of a bounce, a level off, and then kind of a little bit of a slow rise again. I think until we see some of that inflation relief, we've seen the Fed say there are no plans really for in the immediate short-term future rate drops, and it's because of job market strength, which continues, as well as those persistent inflation fears, right? When inflation is afoot, the Fed is not going to drop rates to do stimulus because it'll just urge inflation on. Anyhow, thank you so much for watching. If you love these videos, please do like, subscribe, questions and comments. We love them. And of course, as always, if you're looking to buy or sell real estate here in Southern California, LA and Orange County specifically, we would love to lend you our expertise. Definitely don't hesitate to reach out, and we will see you again real soon.